Bitcoin has once again demonstrated its capacity for sharp reversals in the face of substantial selling pressure, with the leading cryptocurrency staging a recovery that has surprised segments of the trading community and placed renewed emphasis on the $70,000 price threshold as a decisive line in the sand for near-term market direction. After slipping below this psychologically significant level in early June amid heavy liquidations, ETF outflows, and sales from large holders, Bitcoin has rebounded with notable strength, reclaiming ground in the mid to high $60,000 range on the back of cooling inflation data and positive geopolitical developments that have lifted broader risk appetite. This movement has left traders closely monitoring whether the asset can sustain momentum and decisively reclaim $70,000, a level that has repeatedly served as both support and resistance in recent cycles and now stands as a key test of the recovery's durability. At Crypto Hub, we deliver professional and fact-based analysis of cryptocurrency markets, focusing on the underlying drivers of price action rather than fleeting sentiment. In this update, we examine the recent volatility surrounding Bitcoin, the factors behind its recovery from the breach below $70,000, and the reasons why this specific threshold has become the focal point for market participants assessing the strength and sustainability of the current rebound. Our goal is to provide a clear, balanced perspective grounded in technical, on-chain, and macroeconomic realities so that viewers can better understand the context behind the headlines. The early June decline that pushed Bitcoin below $70,000 was driven by a confluence of forces that amplified downward momentum through classic deleveraging dynamics. Large-scale selling from entities that had previously built substantial positions contributed to spot market supply, while simultaneous outflows from major spot Bitcoin exchange-traded funds reduced institutional buying support at a critical moment. These pressures coincided with the unwinding of leveraged long positions in perpetual futures markets, where cascading liquidations accelerated the move lower and created a feedback loop of forced selling. The breach was swift, with intraday lows approaching $69,000, marking the first sustained break below the round number in recent sessions and testing the conviction of holders who had viewed $70,000 as a floor during earlier consolidation phases. Market reports highlighted that this episode shared characteristics with prior corrections, where liquidity shocks exposed overextended positioning and led to rapid repricing. Despite the intensity of the drop, the subsequent recovery has shown resilience, supported by a shift in macro conditions and a reversal in derivatives market flows. Cooler than expected U.S. inflation readings earlier in the period eased worries about immediate monetary tightening, providing a constructive backdrop for risk assets including cryptocurrencies. More recently, geopolitical de-escalation, including progress toward peace agreements that reduced regional tensions, boosted overall sentiment, and encouraged capital rotation into higher beta assets. This environment facilitated the liquidation of a significant volume of short positions that had built up during the decline, generating short covering rallies that added organic buying pressure and helped Bitcoin climb back above $66,000. The speed of the rebound caught some observers off guard, illustrating how quickly sentiment can pivot when technical oversold conditions align with positive external catalysts. On-chain data during this phase showed signs of accumulation by longer-term holders with reduced exchange inflows and increased movements to self-custody wallets, suggesting that the dip was viewed by certain participants as an opportunity rather than a reason for capitulation. The $70,000 level carries outsized importance because it functions simultaneously as a psychological round number, a technical pivot with historical relevance, and a concentration point for clustered orders from both retail and institutional desks. In prior phases of the current cycle, this area acted as support during range-bound trading and as a launchpad for advances when reclaimed with conviction. Following the recent breach, it has transitioned into resistance, meaning that any sustained move back above it would likely trigger additional buying from breakout traders and short sellers covering positions. Volume profiles and order book depth around this zone will be critical indicators. Meaningful participation on the upside would lend credibility to the recovery narrative, while thin or fading volume could signal exhaustion and raise the probability of a rejection back toward lower supports. Analysts have noted that the $65,000 to $68,000 region has emerged as a secondary area of interest where prior buying interest surfaced, providing a potential cushion if the immediate push towards $70,000 encounters resistance. Technical structure around the current recovery reveals a market attempting to rebuild its footing after a sharp correction. Moving averages and momentum oscillators have begun to turn higher following the rebound, yet the broader trend remains sensitive to external shocks, given Bitcoin's established correlation with traditional risk assets such as equities. A decisive close above $70,000 on increasing volume could open pathways toward retesting prior highs, as it would shift market structure from corrective to potentially constructive and attract momentum capital that has remained sidelined. Conversely, repeated failures at this level might reinforce a period of consolidation or deeper retracement, particularly if macro data or liquidity conditions turn less favorable. The presence of significant options and futures expiries around these price zones adds another layer of potential volatility, as dealers' hedging activity can exaggerate moves in either direction during high-impact periods. On-chain fundamentals continue to provide a counterbalance to short-term price noise. The Bitcoin network's hash rate has remained elevated, reflecting sustained miner commitment and the underlying security of the protocol even during periods of price stress. Post-halving issuance dynamics have reinforced scarcity narratives, with models emphasizing stock-to-flow relationships suggesting that reduced new supply, when met with steady or increasing demand, creates conditions supportive of higher valuation floors over longer time horizons. During the recent dip and recovery, wallet cohort analysis indicated that long-term holders were net accumulators, absorbing supply from shorter-term participants and large sellers. This divergence in behavior between patient capital and reactive traders is a recurring feature of Bitcoin market cycles, and often precedes periods of renewed upside when distribution pressure subsides. Institutional channels remain a structural pillar of the market, even as flows exhibit variability. Spot Bitcoin ETFs have experienced periods of net outflows during risk-off episodes, yet the overall infrastructure has channeled substantial capital into the asset class and improved price discovery through regulated vehicles. Corporate treasury adoption, while not uniform, continues to add a layer of persistent demand that differentiates the current environment from earlier cycles. These developments have helped mature the market, reducing some of the extreme volatility of prior years while still leaving room for sharp moves around key technical levels. The interplay between ETF flows, corporate activity, and spot market liquidity will likely influence how decisively Bitcoin can challenge and hold above $70,000 in the sessions ahead. Macroeconomic linkages add further complexity to the outlook. Bitcoin's performance has shown increasing alignment with broader financial conditions, including equity market trends, interest rate expectations, and global liquidity measures. The recent recovery benefited from a combination of softer inflation prints and reduced geopolitical risk premiums, both of which lowered the opportunity cost of holding non-yielding assets and encouraged rotation into growth-sensitive sectors. However, this correlation also means that surprises from central banks, employment data, or unexpected policy shifts can rapidly alter the trajectory. Traders watching $70,000 are therefore implicitly evaluating not only crypto-specific signals, but also the resilience of the risk-on environment that has supported the rebound thus far. Derivatives market positioning offers additional color on sentiment and potential volatility. During the decline, funding rates turned negative as short interest dominated, setting the stage for the short squeezes that fueled the recovery. Open interest levels and liquidation heat maps revealed clusters of leveraged positions that, once cleared, removed some of the overhang and allowed price to stabilize. Going forward, a return to positive funding alongside rising open interest could indicate building bullish conviction, whereas persistent negative funding or declining open interest might suggest caution among leveraged participants. These metrics, when read alongside spot price action at the $70,000 level, help paint a more complete picture of market health than price alone. Historical parallels provide context but must be applied cautiously. Previous cycles featured similar tests of round number resistance during recovery phases, where success or failure often coincided with shifts in broader liquidity and sentiment regimes. The current setup shares some structural similarities with those periods, particularly the presence of institutional infrastructure and a maturing participant base. Yet differences in market depth, regulatory clarity, and global adoption rates mean direct comparisons have limits. What remains consistent is the tendency for psychological levels to attract disproportionate attention and order flow, creating self-reinforcing dynamics until a clear break occurs. Risk management considerations are inherent in any discussion of volatile assets at inflection points. The recent breach and rebound underscore how quickly conditions can change and why position sizing, defined risk parameters, and avoidance of excessive leverage are frequently emphasized by experienced market observers. While the recovery has introduced a more constructive tone, Bitcoin retains its characteristic volatility, and moves of several percentage points in either direction remain commonplace even during overall uptrends or consolidation phases. Observers are encouraged to cross-reference multiple data sources rather than relying on any single indicator or narrative when evaluating the probability of a sustained move above $70,000. The broader cryptocurrency ecosystem often amplifies Bitcoin's moves, with altcoins exhibiting higher beta during both advances and corrections. A successful reclamation of $70,000 could provide a supportive backdrop for the sector as a whole by improving sentiment and liquidity conditions, whereas prolonged rejection might extend risk-off behavior across correlated assets. This interdependence highlights why Bitcoin's price action at key levels receives such focused attention from participants across the market spectrum. Technological developments on the Bitcoin network, including ongoing improvements to scaling solutions and Layer 2 infrastructure, continue to enhance usability and reinforce the asset's long-term value proposition beyond pure speculation. While these factors exert more gradual influence on price, they contribute to the narrative of increasing utility and adoption that underpins institutional and corporate interest. Combined with growing awareness in emerging markets where Bitcoin serves as an alternative to local currency instability, these elements add organic demand layers that can support recoveries even after sharp corrections. Regulatory evolution remains an ongoing variable. Clarity or positive developments in key jurisdictions tend to support price stability and attract additional capital, while uncertainty can exacerbate volatility around technical levels. The current environment reflects a gradual shift toward greater integration with traditional finance, though periodic headlines can still trigger short-term reactions that test levels such as $70,000. Market participants monitoring the recovery will therefore benefit from staying attuned to both on-chain and regulatory signals alongside price and volume data. As the situation continues to unfold, the interaction between Bitcoin and the $70,000 level will likely provide valuable information about the balance of supply and demand in the current regime. A sustained break higher, with supportive volume and on-chain confirmation, would strengthen the case for further upside, while repeated rejections could extend the period of consolidation or prompt a retest of lower supports. Either outcome will be shaped by the interplay of technical structure, fundamental flows, and the prevailing macro backdrop. In the professional assessment of recent developments, the recovery has introduced an element of surprise that has refocused attention on this critical threshold. The breach below $70,000 exposed vulnerabilities in leverage positioning and spot liquidity, yet the rebound demonstrated the market's capacity to absorb shocks and respond to improving conditions. Traders and observers will continue to watch closely for signs of conviction at this level, recognizing that the resolution carries implications for short-term direction and the broader sentiment across digital asset markets. Thank you for watching this analysis from CryptoHub. We remain dedicated to providing clear professional updates on cryptocurrency developments as they unfold. Remember that this content is for informational purposes only and does not constitute financial advice. Cryptocurrency markets involve significant risk, and viewers should conduct their own research and consider their individual circumstances before making any decisions. Stay tuned to CryptoHub for more in-depth coverage, and we look forward to bringing you the next update soon.